There are three institutions. They were fighting against Elon Musk recently. Is Elon Musk making the trillion or not?
Elon Musk said that, listen, if I take this company to a valuation of $8 trillion, you're going to give me shares worth $1 trillion.
Most of America's money is in these ETFs. If you have an S&P 500 ETF, you have. So the person's like, what am I supposed to do?
These proxy advisors have their own agendas and their own rules, which are, so they should not have.
There's a lot of money riding on these indices. So if you are trapped to an index,
Who told you to put all your money behind it? The system doesn't have a way to trace accountability back, and there should be more competition. Anybody can create an index.
why do we have so much money in current accounts?
Who keeps money in a current account? There's a surprisingly staggering 21 lakh crore rupees in there. Now, the reason it is staggering is because
Why they're not doing it?
so if I add up all the net profit after tax of companies, that adds up to only 9 lakh crores. That means for 900,000 crores of profit, you can add another 40,000 crores in profits by just...
So Deepak, in today's episode, I decided we'll make this a bit like a conspiracy theory, but one that is completely grounded in real fact and not opinion. All right.
So,
So here's my conspiracy theory. There are three institutions and one habit/practice that are determining and controlling a lot of your money without anyone knowing about them. And so now let's get into them one by one and see how even when you think you're being objective, rules-based, passive, and words like that, there's actually someone making decisions behind it, decisions you may not even be aware of. Let's start with the most interesting of them, in my opinion, Proxy Advisors. And the reason I call them the most interesting is they were fighting against Elon Musk, which is a brave and interesting thing to do recently, right? So what happened? And is Elon Musk making the trillion or not?
so interesting. So this thing about it started a while back, but the idea was Tesla is a $1 trillion company of sorts. Elon Musk said that, listen, if I take this company to a valuation of $8 trillion, you're going to give me shares worth $1 trillion. That's about 12% or so of the company. And then I'm like, okay, that sounds okay. Because if you take me from $1 trillion to 8 trillion, you're getting like a 7 trillion increase and you're taking 15% of the incremental upside, which is fine.
Sounds like a hedge fund. Yeah.
Sounds like, yeah. And plus, I can't imagine like a Tesla without Elon Musk leading it. I would imagine that, it would become like an IBM, which is very boringly run and all that stuff. But I would imagine that that's a huge incentive to take that company to 8 trillion. And he makes nothing if it's less.
Like
so if
even
it's
at
7.99, he doesn't make anything. Okay. So you would have thought it's a good thing. But then, out come these guys called proxy advisors. Now, proxy advisors are a very interesting concept. The idea is company has to ask for a shareholder vote whenever you're diluting the company at any point, right? The shareholder vote needs to be voted on. People apparently and worldwide decide that, listen, it's too difficult to just ask us to vote on things. We need other people's view on what these things mean when I am asked to vote for them. So there are these advisors who tell you that, listen, you should vote like this. And because it's a proxy in the sense they're telling you what you should vote for, so effectively they're proxy advisors. They're telling you, oh, well, you know what, in this case, vote yes, in this case, vote no. And they said they should vote against Elon Musk's compensation practice because they said it is excessive.
Yeah, $500 billion. He should have agreed for $500 billion.
Come on, we need to negotiate and then work upward.
Yeah.
So I don't know whether that was. They just
No, I think it's a yes/no. I think
it's a yes/no thing. But obviously, at this point, Elon was miffed because there's a history to all of this where he had another compensation package, which was again where he was drawing like $1 a year or something like that. And at some point, he said, "Listen, the company needs to give me a share of whatever incremental." He gave an outrageous figure. We will do so many cars and so many sales and this market cap.
And he actually did it.
He actually did it.
I remember because I sold before he did it, and that haunts me forever. But anyway.
So interestingly, when he did it, a Delaware court said there was some technical error. And therefore, this compensation could not have been given.
But that was a court thing, I get it.
Thing. Then now he put in a proper proposal, and then now the proxy advisors come after him, and then he's like, furious.
Scorched earth, yeah.
So there are two companies, Glass Lewis and I think
IS or something.
Advisory Services, IS. These companies were essentially companies who proxy advise on various set of topics. And I think they were the ones who said no to all of this. And it brings to light the fact that who are these people who are kind of making decisions on somebody else's behalf, and why are they important in the first place? So the answer to that seemed to be these proxy advisors are designed to do a bunch of things, and those bunch of things is essentially read through this documentation, which is usually cryptic, legalese kind of thing, come up with a thing that says, well, we've gone through it and here's what the data is, and that's why you should vote for yes or no. Somebody else looks at this decision, and typically it's, institutions like mutual funds who are basically they hold shares on behalf of their investors, and they are effectively making a decision for all of their investors put together, and they're saying, oh, well, you know what, fine, the proxy advisor tells me we should vote yes, then maybe we should vote yes because they seem to have the data right. And if they say no, they say no. So in a sense, they influence the opinion of the people who do vote in that sense.
I will jump in here to say that I completely understand why this is a bigger deal now, because maybe back in the day, even though Peter Lynch owned a lot of companies, I think it was still always 50 or at the most 60 or something, right? But now you have most of America's money and to some extent India's money also, but we'll come to that, is in these ETFs. So if you have an S&P 500 ETF, you have around 500 stocks. So the person's like, what am I supposed to do? I mean, I don't spend more than 5 minutes managing the money or deciding how the money gets managed. Now you want me to spend 500 companies times a couple of hours per company deciding how to vote. Let me get this nice proxy advisor to go and painstakingly go through everything. I'll read it and I'll go with what he says unless I'm very against what they're saying. Sounds reasonable to me. So what's your issue?
I don't think the problem is as much the fact that they are doing this. Sometimes these proxy advisors have their own agendas and their own rules. So their rules may not make sense to you. They have rules of various sorts, and I can come to, when we come to India, I'll talk about the India specific rules of this, but some of these rules, especially in the US or in other places, have complications. So India also has institutional advisory services. There's a company called IIAS, there's a company called SES governance, and a few others, so smaller ones. In worldwide, these tend to be concentrated in a couple of institutions because the market isn't that big. What happens now is the institutions may have these things, the advisory services may have some rules which are not context specific, in the sense that, for instance, in India, they have a rule that says, they have a rule as in they have their own thing that says a family should not own both the board seat and the CEO seat. Okay. So they should not have both of them. You should have two people from who are not connected. Now, in India, where promoters tend to own more than 50% of the company, have board control and have management control, it is unfair to expect that you will suddenly install a third party who will come and tell them what to do. In fact, even in Tesla, I would like Tesla's board to be headed by Elon Musk. And because anyway, he may be a maverick, but he's managing that company insanely well. And I would rather continue to be him rather than have somebody else in that place. So it's not context specific. It's like, oh, in Tesla, I will allow this. In some other companies, I won't. And so they make these rules across. And then they will tell you to vote against something completely innocuous, like an independent director's compensation. Vote against it because, you know what, the director and the chairman of the board of directors and this one are the same. So you're like, excuse me, how does that have any bearing on some independent director's compensation? But they're like, no, we have a rule. It's a little weird and subjective.
No, I remember this now. I remember what you're talking about. In the US, I think the example was when Trump came to power, he's like, why are the proxy advisors voting against, say, board members or something if they're not in a diversity criteria? Like, I guess in that case, if they're not women or from a minority group in the US, or why are they voting against this or demanding this when they have a ESG criteria? And in both cases, he's like, this is not your job. I mean, that was his view and you should not be doing this. And of course, Trump being Trump, I think he sued them. And I don't know where that has ended other than people just probably burying some of these initiatives. But let's talk about India. Look, but the fact is, Deepak, there are so many fund houses. They need someone to do this, right? So what are we really making the point here? I think the point you're making is I think I can think of two arguments you're trying to espouse. One is that either make it completely rules based, in which case then, I mean, it'll be very hard for the firms to make a living, right? Because it's just a bunch of rules. Or let them use judgment. And then the fund houses have to, or the people managing people's money have to use their own judgment as well. So which is, do you think, the argument you're making here? Or what's your real grouse in this situation?
So let's say you're an active fund that's actually buying stocks, right? I would say it is important for the active fund to maybe have an outside view on the proposal, the same way they use brokerage reports to find out what's interesting about a company and all. Having an outside view is fine. Making decisions is still their responsibility, and you're accountable. They're accountable for their decisions, regardless of who they. A fund manager can't say, "I bought this stock because this brokerage report was very nice and it was in thick double-sided paper." And I'm like, nobody cares. Like at some point, you're accountable for it. So I would say they'd be accountable for the decisions they make. The complexity comes in index funds where like you said, the index fund manager is he's not spent so much time finding out which stock to buy because the index has told him, but now he has to decode what that company, and like you said, the problem isn't just, so it was earlier that somebody would decode this complex shareholder resolution for you and give you something. But in decoding that, they would write a bunch of more legalese. Okay. Which is like, oh, you know what, I looked at the company's financials and guess what, they have told us that they will use 5 crores in this, but they haven't told us whether out of that 5 crores, 2 lakh rupees will go to this auditor, and what was the auditor's compensation last year, so I cannot do a year-on-year increase. And then you're thinking, this is a 6,000 crore company. Why am I even bothering about something that is as small as 2 lakh rupees? I'm sorry, but this is not my call. The board can take its own call, and even if they're wrong, it's 2 lakh rupees. It's not going to change anybody's life meaningfully. You have to make that decision as a fund manager who's coming in and saying, listen, I know this seems to be, they're telling us they haven't revealed the figure last year, but I could always go and dig into the financials and find out. But in general, it is irrelevant. And, at another level, even the fund managers are aware, in some cases, they own less than 0.1% of a company. So no matter what they're going to vote, it's not going to be meaningfully useful. So at some level, some of these small, tricky, little here or little there are almost worthless in comparison. So they don't want to spend too much time on it. But at the same time, they do want to understand that, the proxy advisor's advice is not to be taken at face value. Which means now I have to read the resolutions, they have to read the proxy advisor reports, maybe multiple of them, and then figure out how to vote. Which means it's now 3x, 2x the amount of work as just reading the resolution by itself, right? And now, because proxy advisor becomes such a big thing, like you said in the Trump case around ESG and all that stuff. And that was also very strange because, they would bring it in anything. It's almost like when you ask about how's the weather, a person says,
we're all dying
I'm
from
not going
climate
to
change.
take, correct. There's pollution in the north and, come on, we're all dying. So at which point you're like, this is not relevant to the argument. But no, because
it is important, I'll bring it in regardless.
So that's what they're bringing in. They bring in ESG, they bring in DEI into decisions which don't have any relation. There are those complexities here as well. I saw once public sector banks directors. One of the directors who had to be re-voted in, they said don't re-vote him in because the number of independent directors required is one short of the actual number, and they haven't appointed an independent director yet. So don't allow even the regular directors to be
till they fix
function.
that.
And there were only 4 regular directors. So I'm like, if you don't vote in any directors, how is this company going to function? What kind of nonsense are we talking about? But they have rules. So now that means at the public, at the fund manager level, you have to go in and say, this is ridiculous. I am not going to listen to this. The minute you force me to make a decision about an opinion that is ridiculous, why should I bother with the opinion in the first place? Why can't I go down to the resolution?
But no one is forcing the fund manager.
Yes. So in general, I think we should look at it as advice.
Okay.
The problem is it has become a little more than advice, where the proxy advisor's word has become in a small sense like gospel. And the minute you start voting in a different way from the proxy
advisor,
advisor,
have to justify yourself.
You have to justify yourself, which becomes a problem because many fund managers are like, listen, this is so small, I don't even want to do this, but I have to do it in the spirit of governance. I have to vote against I have to vote in a different way from what the proxy advisor told me. But now I have to face my risk management committee telling me, why did you do this? Give me a report. They give you a 16-page report. Why your report is 2 pages?
Or 2 lines saying it
doesn't matter. So it sounds like crazy, right? So the gospel part is the problem. You should not allow it to be gospel.
You should not. Deepak, so I understand this. I get you on this. But can you're basically saying, look, fund managers and fund houses, take a decision, stand by it, and maybe push back against some of the bureaucracy, and even if the reasons are small. But how would you? They're now going to be passive only mutual funds in India or something. They will have very, very few people. This is something we are okay with creating. I think this is a plan because they're lower cost and whatever. And in my next segment, I'm going to come to these index manufacturers also. But something feels off, Deepak, when you're telling me here that, look, you're almost like shaking these fund houses, like make sure that you're taking the decisions. But what if there's no one to shake? What if the fund house is just a computer? And they're saying, look, we're not spending time figuring out how to invest because we're following an index. We're just being efficient and good marketing and all that stuff. But now you want us to hire an army of people to sit and read these? Doesn't that feel like it's just adding cost for no value?
Which is true. Unfortunately, the problem is that, and if you say that there should be, let's say in a hypothetical world that we decide that these fund managers who are passive should not vote on these resolutions. Now the issue becomes, if a company is majority owned by these passive funds, then you have no governance at all, because nobody's out there to say no or yes or anything like that. You don't want that, so you say, okay, well, you have to vote. But the minute you have to vote, then it is either you vote or you give away your vote to someone else. Now, I don't think you can outsource the activity of voting, because effectively the governance is of the owner. So I could, for instance, as an individual, take my shares and then say, you know what, Shray, vote on my behalf. I'll give you a proxy form. And in that proxy form, you can say, Deepak has told me that I can vote for his shares. I'm voting for his shares, and boom, you're done. This would be perfectly fine as an individual. An institution can't appoint a proxy. And therefore, an institution ends up with this: you are responsible both for your voting decisions and your governance decisions, and you can't outsource either of them. In a passive fund, you have actually outsourced your
investing
decision. But unfortunately, you haven't outsourced your voting decision.
So in the end, we have inadvertently created a situation that for a large amount of money in the stock market today, what is otherwise an advisory proxy firm is taking the final call on how a lot of AUM gets voted, or a lot of asset shares get voted. And that's perhaps not something that they had also envisioned. And I'm not sure if they would be fully thrilled at the idea that they're determining so much of the vote.
Yeah, I mean, if you think of the public sector bank example, would the proxy advisor be happy if all four directors, the only working directors in a public sector bank were told that they cannot be voted? No, at which point they would be like, come on, we didn't think we would have so much power in the first place.
And why have you given us? Someone was supposed to read this and say, I understand, but okay.
But yeah.
Okay. I'd like to come to my second point right now. So this is somewhat linked. It's an extension of this. Index manufacturers. So now this isn't an active versus passive thing I'm talking about. I'm actually talking about the people making these indices, which I believe at this point is only the two beloved exchanges, NSE and BSE. At this point, right?
I think BSE has a partnership with S&P, NSE has does its own thing.
All right, fair. On index manufacturers, I think the thing that's come to mind to me is, as passive grows, a lot more money is going in onto these index funds. Initially, the index funds were a little simpler, or were meant to be simpler, right? There was like top 50 stocks, fine, let's weight them this way, let's weight them that way. There can be some cooling period on entry and all that stuff. It just felt like it was simpler. But now I've started to see that, because we sometimes have customers come in with which have the word index in them. They're almost like quant strategies and so on. So this has made me think that a lot of our money, and maybe you can come back at me with numbers and tell me if my intuition is correct, but we love index funds. You're less dependent on a person, whatever. But at some extent, I feel that a lot of money is going into stuff where someone else is actually making decisions. It's not just a formula. So what's happening here? Are index funds slowly taking over the Indian market? And are the quality of indices sometimes not always perfect?
In terms of size, right now, 35 lakh crores is in actively managed funds. And about 13 lakh crores, equity funds. And 13 lakh crores is in index funds plus ETFs. But about 1 lakh crores is in gold ETFs. So if you take that off, that's about 12 lakh crores in equity, mostly equity ETFs.
That's still a third, right?
That's still a fairly large number. Yeah. It's a third. It was much lower earlier. So I think in 2018, there was about 7 or 8 lakh crores in active index funds. That has grown 4.5 to 5x. But there was only 1 lakh crore in index funds plus ETFs. So if you see that has gone up about 12 to 13x in comparison. So we've seen market share of passive growing.
So 1 out of 8 has become 13 out of 35, roughly.
13 out of 48, or 1 out of 10. Effectively, the growth, while it's still small in comparison, most of the growth has come from, say, an EPFO. which decided not to make its own decisions on buying which stocks. Instead, decided to buy the indexes, putting money into the SBI and UTI index ETFs, which are now one of the largest single schemes in India in general. Now, if this is the case, the growth of the market has come in this way, slowly it has become that more and more money has been coming into the index companies that form a part or a basis of these products, which is typically the top 50 companies in India or top 30 companies. How do you determine the top 50? You say there's a free float market cap. I put everything together and there's the free float market cap of the 50 companies, top 50 companies and so on. But you often notice that the day this rebalance is supposed to happen or whenever they made this decision, at the cutoff date, certain companies are not 50th in the top 50. They may be 55 or 56. So why have they even come into the Nifty? And then when you ask this question, you start thinking that something is wrong because it's no longer an objective function. Is it subjective? Is it who determines this? So it turns out the index manufacturers do, where they say, oh, well, you know what? This company is going to be part of the Nifty 50. But that company, although it has a higher free float market cap, is not going to be part of the 50. So then you're like, why? And then they don't have to answer you. They do have to answer maybe the people who pay them, which is not you, which is the fund manager that you have appointed. But the fund manager can't ask too many questions because they are on the other side. They're like, listen, you have to buy whatever we sell. You can't even, say no to buying what we are saying.
Does the fund manager have the freedom to not follow the index then and say, look, this doesn't make sense to me. This one stock I'm not going to buy?
Not in India. In India, you absolutely have to buy in the equity indexes, exactly the same proportion. So it's almost like at some level, there is a stranglehold because the index manufacturer says you have to buy what I tell you. And even if you came back to me and said, listen, this company, it should be in the index, I might humor you because like you're my customer or something like that, but I don't have to give you an answer that I can give you anything like, oh, you know what, it's done only 4.5 years and we typically want our companies to do 5 years. And if I point out there's some other companies that have done only 3 years, they'll be like, well, that's an exception because blah, blah, blah. So, so at some level you have these complex kind of situations where you have somebody who's making those financial decisions who isn't accountable to you as an investor, who isn't accountable to anybody actually, because in the end they're saying, listen, we're just creating an index. Who told you to put all your money behind it? But at the same time, the system doesn't have a way to trace accountability back. And I think these index manufacturers in general, because there's some proposal to because there are only two of them, there should be more competition. Anybody can create an index. To be honest, we can take the prices of anything and create an index out of it. Why would... But they claim some ownership over the prices, right? Yes. Saying that you can't do it, and if you do it, you can't use it for like creating an index. And yes, so you can use prices if you want, but you can't use it to create your own index. That's part of the rules of dissemination. Okay. So I'm like, how is that even allowed? The prices should be public property. Even though there's been a judgment in the US in this favor, there is no reason why India cannot go in and say all stock market closing prices are public property, and therefore nobody can own the price of a stock. Forget closing, any point in time. There is no reason why any price is not, it should not be made available. Of course, you can say that it can't be made available for free, or whatever. But for the purpose of creating an index, there should be no reason why anybody should be stopped on the basis of ownership of that data underlying. It must have been the HDFC-HDFC Bank merger where you said that, look, the index realized that it couldn't follow its rules because if it did, it would cause a lot of disruption. So it decided to change things. And then you give another example with Reliance. Could you quickly just talk through both of these examples? And the reason I don't know the details enough, but I do know that the index manufacturer used its discretion to save customers unnecessary transactions or all. Yes. So why are you not celebrating them, and why are you in fact saying, boss, you have too much power? Yeah, no. So interestingly, this is actually what happened, and this is where it becomes very murky, right? So Reliance is one of the largest companies in the Nifty index. The largest, I think. Yeah. So yeah, well now HDFC Bank anymore. Is okay. But since it was the largest company on the Nifty, because it's by free float market cap. Yes. That's why. Not that it has a larger market cap in general, free float market. But Reliance actually had this demerger with Jio Finance. Now, typically, the rule before all this happened was that if there was a demerger in a stock, the stock would be taken off the index. the demerger would happen, and then the stock would be added back to the index. In many of the small indexes, that's what happens, because they do not know in advance the price of the stock post the demerger. What if it's a 100 rupee stock and the demerged stocks becomes 90 rupees? The current stock stays at 10 rupees. So what weight do you give it during this interim time and so on? So given that they used to do this, except now Reliance was demerging with JioFin, and then they couldn't take Reliance off the index. It's too big. Yes. And too much money follows this, and all
obviously, yeah.
And they said, well, it doesn't make any sense to remove it. So guess what? All the index fund owners will effectively own JioFin. Now they'll take the JioFin and they'll try to sell it. They'll try to dump it in the market. Now, what will happen if everybody tries to sell JioFin at exactly the same time? So we'll keep JioFin in the index for 5 days. You guys sell the JioFin and then we'll take it off. So it's a guaranteed take-off kind of a mechanism. Some kind of respite you would think. So say, okay, that's done. And then there was this massive merger between HDFC and HDFC Bank. Now, HDFC and HDFC Bank together formed the largest weight of the index. Each one was about, say, 7-8%. They were together about 16%. Now, typically when there's a merger, again, you don't know what the whole thing will be. So you typically take one of the stocks out of the index, whichever is getting merged into the other one, and leave the other one as it is. So what would happen then is HDFC would go out of the index. So HDFC Bank's 8% share becomes, I don't know, some 10 to 11%. Then HDFC gets merged in, and then the together entity becomes 16%, which is unnecessary because all these index funds have to sell their HDFCs, come back and buy more HDFC Bank at a later point, which makes no sense whatsoever. So they said, okay, you know what, let's keep them in the index till the last day. So they made these exceptions based on market happenings, realities and all that stuff. But at a base fundamental level, you're thinking like this. The index is supposed to be a barometer of the stock market. Means it is just an indication of what's happening in the top few stocks. Why is somebody changing the index characteristics based on whether some stock is getting merged, demerged, whether it's a big stock getting demerged or small stock getting demerged? Why are they doing this? So
because there's too much money on it,
yes,
and that money is forced to follow it even on a technical issue.
Which means they are actually becoming fund managers. They are not becoming index manufacturers. Yeah. They are handling it as if they are managing money.
They're taking care of your money for you. Yeah.
At which point
they're like, I'm not going to make you spend so much buying and selling. They're literally looking out for you.
Looking out for you. It then brings it to, if they are becoming fund managers, then they should be fund managers. They should not be able to hide as just index manufacturers by saying we have a rule-based system when you don't. So you need to either start taking responsibility. So why aren't these index manufacturers voting on the shares that we're talking about? If you're anyway managing my funds, you might as well vote on my share.
But if I'm thinking from customer's point of view, they'll say, Deepak, I understand your point. There's a failing in the market, but look, at some level, I feel they're all trying to take a sensible decision. Yeah, maybe they're not allowing someone into Nifty who should be into Nifty, but overall, I didn't know better myself. I'm fine with it. I think, can I posit this to you and tell me that I started seeing a couple of indices where it didn't look like an index. It looked like a quant model. Like basically it's like, look, this is like a strategy. This is almost like a fund manager coming and pitching you, hey, I have this cool quant strategy. Let's do this. And then you're like, look, if you were to in all faith evaluate someone very strictly and objectively, not that, everyone does, but you would be like, look, I want your data, I want the back test, I want these results, I want it to be reproducible. You demand so much of it. And given that many of these indexes will soon be managing more money than any probably random fund manager, it's quite a black box for something that's so important. Would you agree with this?
I would say yes, in the sense that if you tell me that an index follows a certain philosophy, I should be able to run my algorithm and then say, you know what, you're right, it follows this. Yeah. So if you tell me that this is the index, we want to replicate it in our way, I'll pay you. But give me the underlying workings of this whole thing. Then you find out there's a certain stock that should have come there. And then you say, why didn't this stock come there? And they go back and say, well, you know what? No, well, it didn't come. It didn't qualify. But you say, well, according to your rules, it did. No, we had a rule that said it had to be at least 3 years in existence. I'm like, okay, fine. You added another rule. But then you didn't buy this stock, which still qualified. Or you bought this stock, which kind of shouldn't have qualified because of this rule. And then they kind of say, no, it's our system. Yeah, you forget. The minute you say that, you're not an index thing anymore. And then so I keep wondering whether that is making them more of a fund manager than it is making them an index manufacturer. In many cases, index manufacturers are simply, like in the US, you could create an index out of anything, including my whims and fancies index. So, which is,
I know they have ETFs for everything.
for everything.
Right? Yeah.
So because you have a my whims and fancies index for everything, so they don't even try to pretend that these are noble anti whatever and all that stuff. And many quantitative strategies, or not even quantitative, let's say Cathy Wood. Yeah. Cathy Wood has ETFs against.
But she doesn't have an index. I get your point. ETF there is just a wrapper.
It's just a wrapper.
But I completely take this point that is this something that is a public good, or is this money being managed?
Is this money
being managed?
Just,
I mean, public good may not be the right word, but is this a foundation, or is this money being managed?
Yeah. So I would say the alternative might be an open source index, where if the prices were available, anybody could create an index of the top 50, and an index fund would have perhaps the flexibility to say, I'm going to take any of the top 50 indexes that is out there. If something is better, I will record the reasons for doing so. But when I do that, this other index will not make those subjective decisions of when to add or delete a stock. I will have a committee that decides on these case by case crazy situation basis with transparency about why they did certain things, and those reasons will be out there and discussed in public, and this will become our new open index architecture. Then what will happen is even the NSEs and the BSEs of the world can't hide behind, I will not tell you my system's details, because this other guy is out there saying, I will give you my system's details.
No, I get it. I mean, the point is that there's a lot of money riding on these indices. So do you really want it to be like, look, folks, we've got this, trust us? I mean, I'm like, at some point, when the money becomes too much, you can't just be trust us. And I think the reason you're holding them to a higher standard than a fund manager, because a fund manager is not obliged to tell you, I bought this stock because of X reason. Then you can say, oh, but that stock also followed X reason.
Yes.
He's like, look, if you don't like it, you can go away. Here you're saying you can't really go away. So if you are trapped or committed or wedded to an index, then the index is forced to behave at a higher level of transparency or professionalism, whatever you want to, whatever is the right word in engaging
for it.
people.
Yeah, no, and to be honest, if the reason we invested in index was they were supposed to be objective, and you've increasingly got subjective behavior in the index construction, then am I to believe that the back test is no longer going to be the forward test, which is what active managers have to tell you, that past performance is not reflective of future realities, right? So
no, I think there's a blurring of lines of what the index really is. It's not in this case, like or what perhaps the manufacturers in the index claim it is, and what customers perceive it as, and what fund managers treat it as.
Yes.
Okay, I'd like to go to my third secret player behind the scenes today, someone you're not very fond of at all, despite the fact that you have many good friends in many of these institutions, credit rating agencies. Now, we got a lot of, I think actually appreciation, believe it or not, for an episode we did about credit rating agencies grading sovereign debt and talking about how they had double standards. It truly wasn't objective, and it seemed to have just very strange biases at work over there. But when it comes to now within India, so I guess this means debt only, right? It's just mostly debt. So when it comes to just with debt within India, as an Indian retail or institutional investor, do you have grouses with credit rating agencies when it comes to them dealing with debt in India?
Yeah, no, this is an interesting point, because of course they can also rate mutual funds. So in that sense, they can just not do only debt, but when they rate things, they typically rate things as a grade. So that's AAA is the highest grade, and then it goes to AA, A, triple B, B, double B, eventually B, C, and D. So D is defaulted, and everything else is some version of how far away am I from default. So the issue of a credit rating agency in general is that not that they are rating, because everybody can rate anything. Like I can say this company is good, this flower is good, this, because I think it's good. But is that the other person is forced to buy only what I say is good. Okay. Because a mutual fund, like most corporate bond funds or other funds, are forced to buy a certain number of, or forced to buy AA or AAA rated for bonds only. The NPS, which is a system, they have corporate bonds which are only rated AAA or AA. There is a rating requirement for everything that comes in, and these rating requirements can get very, very dangerous, because now they force you to listen to whatever the rating opinion the rating agency has. And the rating agencies themselves may not have any kind of a and they do not have any kind of a standardized rule for evaluating that something is AAA or something is AA. I would imagine AAA means the least likely possibility of a default, right? But what if the least likely possibility of a default at the company level was different from, so for instance, there's a cash-rich company that's coming to the market for the first time. It's cash-rich. It's got like 500 crores in the bank. It's borrowing 50 crores. Is it going to get a AAA rating? Not even a wild chance. It's probably going to get an A rating and have to borrow at 13%. Versus a AA rating where it can borrow at maybe 7.5 to 8, and a AAA where it could borrow at 6 or 6.5.
You can borrow at 6.5 today?
Well,
or
depending on the time period. Yeah, I think
illustrative.
for a 1 year period right now, it's very competitive, and you can get 6.5 to 7 in the
You're
1 year
giving me a
range.
lot of ideas, but unfortunately I can't invest in it anymore.
So really, but it's an interesting concept where 6.5 is. So who gets this AAA? So the answer must be, if they're not giving it to a company with a 500 crore cash hoard for a 50 crore bond, then who are they giving it to? The answer is, if your name is L&T or Reliance or
Tata or something.
Tata or something like that, they're giving it. And then you look at the reasoning of why they're giving it. We found a letter of comfort from the parent group that said, what is a letter of comfort? A letter of comfort is a letter saying, if something goes wrong, I'll support it. It is not legally viable. It is not a legal letter that if this bond defaults, I will pay. That would impose an actual restriction on the parent group, where it would have to be counted in their debt obligations as well. But no, they just say it's a letter of comfort. We're not giving an actual guarantee. So given that it's not a guarantee, it's a letter of comfort, how are you giving anything a AAA rating based on that? There were lots of rating agencies that were doing this in the past, and maybe they are still now, but they look at letters of comfort or something like that. They look at parentage. The promoter is well funded, so they will take care of this, so we're going to give them a AAA. Really? I mean, how does that transport itself into a better thing? The fact that somebody, let's consider this. If your answer was that the promoters were good, then how come a company like ILFS, which apparently, or a bunch of companies around ILFS, collapsed despite having a AAA rating, and the parent didn't even try to support them, or DHFL, or many of the others. In fact, 2 bonds owned by L&T once defaulted, simply because they said, the projects which they were financing, the bonds, they decided to default on those bonds simply because
those projects were not viable or something.
The project, there was some road acquisition for those projects. Those bonds went to D. Okay. But L&T said this is an entity that is bankruptcy remote compared to L&T itself. So L&T's own rating didn't get affected. Okay. But this bond that was issued by an L&T owned-ish company defaulted, nothing happened to them. So if an L&T owned companies' bonds can default and L&T's rating cannot get affected, and if sometimes a government owned company's bond has defaulted as well, and nothing happens in that sense. So is this rating of any real meaning? The answer seems to, in fact, the answer in the market is no, because in the market people knew that ILFS was never a AAA company.
And you saw this in the yields and stuff.
Yeah,
like that.
So the yields that at the time, yields were about 7% perhaps, but ILFS was paying 9% as a AAA.
There was a gap.
So there was a gap, and that gap was enough to say that, listen, we don't really believe this is a AAA company.
So, but I think what I'm hearing from you is, this time it's a more nuanced point than say earlier. It was like, look, there will be, people need to make opinion. This is not a blind rules-based system. In fact, we shouldn't advocate for one, because on that, then that company with 500 crore cash won't be able to get a better rating when it should perhaps be able to. People will have to exercise their judgment. So if people will have to exercise their judgment, why is it that you're not giving the fund manager that level of freedom, but you're giving it to the credit rating agencies, when the fund manager is actually responsible for the money, not necessarily the credit rating agency to the same extent? So the fund manager can't say, boss, I followed the credit rating agency and because of that, I lost money. I mean, they're not able to come up with that excuse. So some freedom needs to be introduced here, where I guess the fund manager gets more, or chooses to take on more autonomy, or something to that effect, so that, again, the person who's whose neck is on the line for your money is the one taking the calls and the one responsible, and not basically he's not outsourcing or deferring it to someone else.
Yeah, I think that is the important point, because we don't want people coming back to us and saying, I bought this bond because it was AAA.
Yeah.
You don't want people, and you'll never allow that. You'll never allow anybody to say, oh, this was AAA, I bought it and it was fine. Nobody is pairing mutual fund manager for buying, let's say, a Yes Bank 81 bond and losing money on it. They didn't buy it, I mean, for the most part. But 81 bonds did lose money at the time. And there were some mutual funds, unfortunately, which had them. Not many. But when they did, they can't stand the excuse of saying, we bought a bank bond. And therefore, how could it default in the first place?
We never saw this coming.
We never saw this coming. You take the hit because you say that it was my judgment that took a call. Right?
And so a customer can then punish you by saying, or be like, look, so then if I don't trust your judgment, I'm taking money out of you and going to someone else.
Yes.
But as always, you can't, you still need the credit rating agencies. So in a sense, there's no, I don't know if skin in the game is the right word, but it's not easy to hold them accountable for their decision because there's no mechanism to
Yes, and honestly, all the three Indian credit rating agencies, the large ones, are all owned by the US credit rating giants. Okay. So in that sense, there is a problem at some level of sovereignty as well. But that could be changed very easily. You can, because all the management is Indian, you can quickly flip over the management to Indian. I mean, the ownership to Indian by if there was an issue of that nature. But I would say the problematic entity is the fact that you have regulation. I mean, forget this. RBI says, listen, if you lend money to a AAA rated NBFC, as a bank, then the bank needs to put X amount of capital against it. But if it's a AA rated NBFC, you have to put even more capital. So the bank actually wants to lend to AAA rated NBFC. So you want to go rating shopping and call the NBFC guy, the rating guy, and say, listen, hi, what do you need? I will take care of things. Please help me do this. And the credit rating agencies also, like in the US, have other businesses. And
this was famous in the financial crisis, where basically you felt that the credit rating agencies were rating their customers, and so in the sense, if the customer was very big, they ended up giving them a more generous rating than was deserved. I completely get the point. It's just that I think your real point is that we should not link things too much or too strictly to the rating then.
I think that's important also, because then it doesn't compromise ratings. And I'll tell you where it becomes a big problem also. Let's say there's a company that has taken a bond. That bond has 7-8% interest rate. But the bond has a covenant, and the covenant says that if your rating falls below AA, you will pay 1% more. And for every drop in rating since then, so AA becomes A becomes B, triple B, and so on, you'll pay another 1% more. Now, there are actually 3 notches. Everything has a AA, is AA plus, AA, and AA minus. So there's 3 notches in each grade. And in those, so for each notch, you could, say increase my interest rate by 1%. But think of a AA company that suddenly has got downgraded to A, 3 notches down to A. It's going to pay 1% more. But the reason it was downgraded was because it was having difficulty paying anything in the first place. That's why you decided to downgrade it in the first place. So now, how can a company that did not have the ability to pay when you had seen it starting to downgrade have the ability to pay even more? You're going to make that company even weaker. Now, the credit rating agency did not want this. It does not want to be responsible for a company's bankruptcy, because this could easily spiral down into from a triple B down to default, right? So also, what happens is, if you have one bond with this covenant, there may be another bond with another covenant, which gets triggered when the first bond's interest rate goes up. He says, if any other bond has been, is paying a higher interest rate, we got to pay. So you'll end up with this structure, which cascading effect, and it could bankrupt a company. Now, credit rating agencies don't want companies to go bankrupt because of them. So they want to now therefore delay this downgrade as much as possible, to the point at which it is inevitable there's a downgrade. The market participants don't see it that way. They start pushing the price down much earlier than that, saying, I don't. So what happens is, a mutual fund that owns all of these bonds is sitting there saying, now I'm trying to sell them. There's not one human being that wants to buy them. These bonds are yielding much more than other comparable AA bonds, but since everybody is aware that there's going to be a downgrade, nobody wants to buy them. So you end up with these bonds sitting on people's books. They have to eventually create segregated portfolios. So now the credit rating agency is even more worried about downgrades, because the minute it starts downgrading, mutual funds are sequestering portfolios, doing other things and all that stuff. So you've created the guy who's supposed to be independently rating a company now has to be worried that his own rating causes the company's downgrade and the downfall.
So this person is now worried about the fate of the company and the investors in that company, which is not, you wanted them to be somewhat aloof from all of this.
Yeah, you want to evaluate the company independently.
So same problem as the index manufacturer. They have more power than perhaps they even wanted to, because they're like, look, dude, if I do this, if I actually follow like some standard procedure, this will be catastrophic for so many people. But do you want them to be thinking that way? I mean, then again, they're just managers.
And creditors, people don't, they're smart guys. Undoubtedly, and some of the smartest people I've met are in the debt and credit risk segments. But I also know that they're also innately aware that this thing is more powerful than it should be. And we might change things by diluting the rules somewhat, by saying, listen, fine, you're a corporate bond fund, you can buy AA or AAA. But if you decide to buy some other bond which is rated differently, then you've got to have a justification of why you've done this. So for instance, a company that decides to put a fixed deposit against a bond, saying, listen, this 500 crore company, technically it wants to build itself into the bond market. It's going to be like, listen, I have a fixed deposit. I'll give you 60 crores instead of 50 crores. I'll put that 60 crores into a fixed deposit and I'll pledge it against the bond units, which means that if the bond units default, you can use the fixed deposit to release it. Technically no risk. So should this be AAA or AA at least, you would imagine? But the answer is no. In some cases, yes, because they'll call it a AA with an SO, structured obligation in this. But a structured obligation can be anything, including the promoter saying, fine, I'll pay if he defaults. But the promoter in the ZSL case, the Z promoter
if something bad happens, it's likely that it may happen to the promoter.
Group. Yeah, so he was in trouble as a promoter, and all the downstream companies couldn't pay their bonds, though they were marked, I think, AA with SO in them, and the SO became so what rather than.
Why do we have so much money in current accounts? Could you weigh in on this?
Yeah, so there are three kinds of accounts, right? Fixed deposits are one where they give you a fixed term and a fixed interest rate on it and stuff like that. Then there is a savings account where people like you and me can put our money. We get a small amount, maybe 3-4% and all that stuff. Now, fixed deposits are maybe 1.3 lakh crores today. That's 130 lakh crores, so 130 trillion rupees. 66 trillion or 66 lakh crores is sitting in savings accounts. The complex part is current accounts. Companies, typically corporates, will put their money into the banks. Banks refuse to pay them any interest. So they'll say, listen, either you make it a fixed deposit or it's going to stay in a current account. A current account pays you no interest at all. There's a surprisingly staggering 21 lakh crore rupees in there. Now, the reason it is staggering is because I was just thinking about this and I said, who keeps money in a current account? If you keep like 1 lakh rupees in a current account, you're probably not going to use all of it. If you did and so you gave it to somebody else, those people might take it and put it into fixed deposits or something like that. The answer is that then the number, this 21 lakh crores, should keep varying quite substantially between
quarter to quarter
or week to week. I get weekly data as well. So, or fortnightly data. Since it doesn't vary too much, it's presumably not also spent in full. Maybe let's just say half of it is getting spent at all points in time. Why don't corporates put the other half in a liquid fund and earn some interest out of it instead of getting zero? The numbers are staggering, because if you look at 21 lakh crores, assume that proprietors of small companies own about maybe 20% of this universe. That's about maybe 3 or 4 lakh crores. So 17 lakh crores is still sitting in corporate balance sheets. Now, these are sophisticated corporates, so they should have some kind of a thought process and system around it. But let's say there is about half of that money, 9 lakh crores, is kept in liquid fund, and that liquid fund is accessible within a day's notice and yields about 5.5 odd percent, right? So typically, 5.5% if they made in the whole year, that would add about 50,000 crores pre-tax. You take out tax, is still about 35 to 40,000 crores. Now 40,000 crores sounds like, oh, that's an interesting number. What's the number in correspond? So if I add up all the net profit after tax of all public and private limited companies in India, that adds up to only 9 lakh crores. That means for 900,000 crores of profit that is generated in India, only 45, you can add another 40,000 crores in profits by just parking half the cash balances you have in current accounts. That sounds like excuse me, why are people not doing this already?
So I was going to come to that. Look, I know one example why they're not doing it. We had gone to some startups who had raised funding and didn't need that money right away. So they were looking to invest it. They had a choice between buying a gazillion fixed deposits or just doing the one liquid fund. And they came up against the NBFC rule. Could you talk about that?
Yeah, so the RBI has the RBI Act has a rule that says if a company's got 50% of its assets in financial securities and 50% of its income coming from financial purposes, you are effectively an NBFC and therefore you should register with RBI. This sounds crazy, but it has almost like if you don't, we'll shoot you, that kind of thing, So if I mean, those kind of implications. Now, the issue with this is that the liquid fund is a financial security. So a startup that's starting probably doesn't have any revenue, won't have for another 2 years because it's in research mode. It's going to get, put its money, let's say, in the liquid fund. The minute it does that, it's more than 50% of its assets are in liquid funds. Then it uses the liquid fund to generate some money out of it so that it can use it for its salaries. So most of its income is also from the liquid funds gains. So when you have most of your money from financial income, which is again more than 50%, and you have most of your assets from financial assets, you are now an NBFC. So the startup, the poor fellow who was probably designing, I don't know, AI tech or technology or I don't know, maybe another way to build better brooms. But whatever it is, it's not a financial company, and yet it has to now become a financial
deemed
company.
NBFC in that sense.
In that sense. So I think that's a bad rule. We should remove it somehow, remove and dilute this completely, or make it just 20%. I mean, so it should be
I'm sure someone with the application of thought can fix
it. And in that sense, if that is the case, then you actually have a situation where liquid funds could actually be used. But you know what? For such companies, I would even say use a fixed deposit. The unfortunate
I want to say, why aren't people doing that? Because it's not like you're talking about, say, busy or tired individuals who can't optimize their life, right? These are corporates who have, I guess, owners, shareholders. They're out there to maximize their profits at some level. So they should be doing this already.
They should. But I think many people just don't have the right kind of advice. And banks also are looking at you and saying, listen, if you've got 10 crores in your current account, I am not going to tell you remove it because I earn the money out of it.
Yeah, but the corporate should do it themselves.
The corporate should actually be thinking of at least having one person figure out how to put the money into liquid funds and take it out whenever they want. So if you have a large amount of money, just put it into liquid funds.
But what's the issue with fixed deposits? I mean, we all love fixed deposits. Yes. Why can't the corporate do the fixed deposits?
They could do the fixed deposits. One of the problems with fixed deposits is, of course, I think it's a much better approach than putting it directly into this thing. And you can do this linked fixed deposit where you say
Flexi. I think it's Flexi or something
like that. Which is basically you if you put a check in your current account, it will draw away from your fixed deposit balance. But then when we did this, and we do this for some of our funds, we realized that what the banks do is they say, well, you know what, I'm giving you 7% as a fixed deposit. But let's say I took out half of that money because I needed it in 6 months. I'm thinking, worst case, there's a 1% penalty. So I'll get at least 6% for that money. But the answer is no, I end up getting like less than 5%. Because what happens is they say, well, you know what, you kept the money only for 6 months. Yeah. So originally, when the day we contracted this fixed deposit, the 6-month interest rate was only 5.7% or 6.7%. And then I'll take another 1% penalty off of that. So I will say you'll get 4.7 or 5.7, something substantially lower. And you're thinking, wait, if I was only going to get 4.7%, then this is a useless fixed deposit because I knew that I needed the money in 6 months. Whereas in a liquid fund, you'll get that 5.5% after you finish your first 7 days. You'll get that money, and nobody will be able to take that away from you. So you'll get whatever is evolved without those harsh penalties and so on. However, I understand there's an RBI NBFC rule, and although I am proselytizing that they should remove it, nobody's going to remove it just because Deepak Shenoy says so. So I think to avoid that, you should definitely have some of this money in fixed deposits.
And maybe you can layer them. But Isaac, everyone says, look, but if I have to optimize my cash flows that carefully, is it worth it? Because if I get one wrong,
correct,
it's so much, it's almost like insurance, like having a little extra money. It's almost like how a person thinks about the emergency account. Yeah, I know it's not very efficient, but it's there.
But it's there, at least, yes.
Hopefully my company is profitable and successful enough that it can manage having these little bit of extra money in the current account.
I would have been perfectly happy if out of 21 lakh crores, there was only maybe, if your whole net profits are only 9 lakh crores of the entire industry, then why would you have 21 lakh crores sitting in current
it's a
accounts?
big
I think
number.
it's a large number. And I would say more money needs to be in fixed deposits in general. That would be more efficient. But I would say at this point, the hidden thing here is that these small optimizations make a lot. I mean, look at a company making, I don't know, say they raised 5 crores. So 5 crores of funding nowadays raised by a guy who sells.
I mean, if you write AI on the thing,
yes,
you'll get
I mean, AI, sorry, 5 million.
Yeah, sir, 5
we don't
million.
talk about 5 crores anymore.
Yeah.
But assume that you raised a 5 million, let's say a 5 million round.
Yes, sure.
That's about
40 crores,
40
I guess.
crores, yeah.
Oh, no, sorry, I take it back. It's almost 50 now with the
50
exchange
now
rate.
with the
yeah.
exchange rate, 45 or so. So you're talking about 45 crores, and even if you put 22 of that, half of it sitting in a fixed deposit, spent the other half because you haven't raised for a year, you raised for maybe 1.5 years, right? So you spend around half of it during the year, and the remaining just 20 crores sits in a liquid fund. That 20 crores will earn you more than 1 crore, which is enough to pay maybe an AI engineer in Bangalore. Yeah. But unfortunately,
you can pay for it. But I guess, Deepak, my only response is, look, the same way I didn't feel any sympathy per se for the fund managers. I understand their situation, but I'm like, look, dude, I mean, if you're becoming a fund manager, you have to make this work. I think over here, I'm like, look, once you're a corporate, this is your problem.
This is, yes.
I mean, but I guess as a government or whoever powers that be could be like, could we create infrastructure where we're not making the easy choice for everyone, let it be, and let's lose out on this money. This is money in a sense that's being earned by the banks, right?
It is, and it's unnecessarily, it's lazy banking, right? So if you get money for free, then why do I have to really work hard for my money? And then they charge us these exorbitant interest rates when we want to borrow, and they give us so little when we want to lend, when we want to give them money. So at which point I'll say, let's get more efficient about our money ourselves. In the US, more money sits in money market mutual funds than they sit in bank deposits per se. That's other than the few banks that keep a lot of deposits. So these money market funds are essentially people optimizing their current accounts. And you could have instant redemptions. Liquid funds have a 50,000 rupee instant reduction. I hope they can increase it to 100,000. But let's say they do, they keep it at 50,000 also. That means 50,000 available in your fingertips like that, and then the rest within a day or so. These are all, I think, easy things to kind of get done.
So reduce the buffers that people are keeping, because people are building inefficient buffers for whatever reasons. Let them need less. I mean, basically, if someone can redo or tweak the current ecosystem, reduce the need for us to keep buffers. It's almost like a Blinkit example. Like earlier you used to keep 10 kgs of something at home. Now you just order it 1 kg at a time.
Yes, I mean, you just ordered one. Yeah, sometimes you have no inventory at all, and you could. I mean, now of course the systems are very efficient, and today you've reached a situation where liquid funds are hyperactive. Usage can be much faster, and to a large extent, people in today, you can even take a loan off of a liquid fund online within 5 minutes at very reasonable rates. So instead of even redeeming the liquid fund, if you need to, you can actually temporarily take a loan and pay it back. If the money was going to come back to you at the end of the month as a salary anyway, or that you need the money only for a short period of time, it's much easier to do it that way. But I won't say those are like power user kind of techniques. So,
got it. Okay, Deepak. So thanks for that. So 3 institutions and 1 habit that are secretly controlling a lot of your money. Let's see if any of these change over the years to come.
Awesome. Yes.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.